And welcome
Real
to
quick.
today's webinar on unlocking the power of self-directed IRA. I'm Michelle Stack, co-founder of Crownstone Capital, and I'm joined today by my partner, Samantha Mastardi, and our collaborators, Celeste and Lorenzo Rulli from Ballora Equity Partners. We're also excited to be joined shortly by our special guest, Ramez Fakhoury, VP at IRA Club. Today's session is meant to educate, empower, and hopefully inspire you to see how your retirement funds can do more, specifically, how they can be used to invest in real estate through a self directed IRA. We'll start with a quick introduction to who we are and why this webinar is so important to us. Then we'll dive into a self directed IRA and what it actually is, how it works, and the key benefits it provides. After that, we'll bring in our guest speaker to give you a deeper look at the retirement system and SDIRA process, followed by a real world example and a Q&A session. To keep things flowing and make the best of our time, we kindly encourage you to jot down any questions you have as we go, or feel free to drop them in the chat. We'll dedicate the last 5 to 10 minutes of our webinar specifically for questions to ensure everyone gets the clarity they need. At Crownstone Capital, Samantha and I help people passively invest in real estate. We come from nursing backgrounds. I've personally been a nurse for over 20 years, so helping others is truly a part of who we are. Our goal is to make real estate investing more accessible, especially for those who may not think they have enough cash to get started, but might be sitting on unused funds in a 401k or an IRA. Our philosophy is simple. We only invest in deals we believe in ourselves. That means putting in the diligence and doing our homework before presenting opportunities to our investors. We care deeply about providing stable, long-term financial growth for people looking to build generational wealth, because we know what it means to work hard for your money, and we want your money to work hard for you in return. In saying that, I want to introduce you to Lorenzo Rulli, and he is going to talk about Ballora Equity Partners. Go ahead, Lorenzo.
Thanks, Michelle. Hi, everyone. My name is Lorenzo Rulli. I am the co-founder of Ballora Equity Partners alongside my wife, Celeste Rulli. Celeste and I are passionate about helping others build wealth through multifamily real estate. Our background is in financial analysis and conservative underwriting, which simply means we don't just look at a property and say, oh, hey, this looks good. We thoroughly analyze each deal, looking at potential returns, risks, market conditions before we bring anything to our investor network. For those unfamiliar, underwriting is the process of evaluating a property's financials, performance projections, and risk profile. It's essentially the due diligence that ensures the numbers make sense to approach the deal. Some of you may already be familiar with underwriting, especially if you have invested before, but for those who aren't, think of it as the backbone of sound investing. At Ballora, our core philosophy is to protect investor capital through rigorous conservative analysis. We believe investors should ask questions and understand that all investments carry risk. Our job is to mitigate those risks as much as possible before a deal is ever presented. That includes careful analysis and then aligning the right team for the right project, selecting operators, property managers, and partners who we trust to manage those risks appropriately. We prioritize transparency, resilience, and trust in everything that we do. If it's not good enough for our families, it's not good enough for our investors.
And now we would like to introduce our guest speaker, Ramez Fakhoury. Ramez is the vice president of the IRA Club. The IRA Club has helped thousands of investors take back control of their retirement accounts, managing over $1 billion in assets. So go ahead, Ramez.
Samantha, you're the best. So I'm one of those rare speakers that loves QR codes, and here's the reasons why. I share a lot of information, a lot of graphs, a lot of charts, a lot of numbers. Would love for you guys to actually hold your phones. So again, pull them out. If you are actually joining on your phone, welcome. Maybe you take a screenshot and then you could actually scan that QR code a little bit later. But as the rest of the team has just told you, we are here to talk about how to harness the power of a retirement account. I don't care to talk too much about myself. I'm boring. I like to talk a little bit more about the IRA Club And I always like starting off with the analogy of many of you have retirement accounts. Many of you may be currently employed with a 401k, a 403b, a 457, a TSP. And the question always aligns with who's IRA Club and why are you different than, for example, Fidelity, Vanguard, and Schwab? The answer is very simple. The only difference between IRA Club and Fidelity is the fact that not only do I let you invest in the stock market utilizing your retirement dollars, but our bread and butter has always been alternative assets. So we allow our investors to use their retirement dollars to invest in real estate, land, syndications, multifamily deals, crypto, anything your heart desires. There's only one catch. I could never choose the investment for the investor. So that is the main difference between your classical brokerage firms and a self-directed company like IRA Club. And make no mistake, the term self-direction is just a marketing term. It really means control. And I don't mean to sound like a broken record a little bit later, but I'm going to use that word quite often, control. But I want to start off with a couple questions. And one of the questions I always like when we sit down with individuals, okay, is we start with this. What is your number? What is it that you actually need to retire with if you were just to stop working today? And believe it or not, the average household is doing about 77,000 per year, okay? But here's what's crazy. 65-year-olds, individuals that are actually have retired, that number is not far off, being at 50,000. What's funny is they say that you need about 1.1 million to retire comfortably at the age of 65. I think you guys are way off, meaning some economists. I'm thinking that number is more like 1.8 to 1.9. Why? Because the rise of living goes up drastically, typically every decade, right? Why am I saying this to you? If we're talking about inflation, right? We're already at 2 point. If I'm so sorry, inflation is rated at between 1929 to 2004 at 2.1%. Believe it or not, we are already okay at 2035 numbers. That is a scary, scary thought to have. So what I'm trying to get at is that 1.1 million is not enough for us to live off of. The second question I want to always ask is today, think about this. Every single thing is working against your retirement account. Stock market is unbelievably volatile. We have no idea what Trump or Elon Musk is going to say or what economist is going to say. It drops, it comes back. We don't know the exact breakdown of what 2025 is going to lead to. Not to mention taxes. Okay, taxes will never be cheaper than where they're at right now. Not to mention every single government program that we have is in complete shambles, from Social Security to Medicare to Medicaid. Not to mention most companies don't offer pensions. Inflation, although heading in the right direction, I believe the official number is, I think it dropped a little bit, 2.3, 2.2. But again, it works against you. I don't know about you, Samantha, and the rest of the team, and Michelle. I feel like it's higher than 2.5%. Every time I walk in a grocery store, I walk out with $300 with 2 bags, and I'm like, what is going on? But the point I'm trying to make is if everything is working against your retirement, how do you protect it? And the answer is very simple. You can't rely on just the stock market, okay? You have to diversify your retirement portfolio. And the only way to do that is through alternative investments. In fact, our clientele base here at the IRA Club, this is what it actually looks like. So, what we believe is in the Yale model of 30, 30, 30, 30% real estate, 30% private equity, multifamily syndications, and 30% being in the stock market. Again, not that we have an issue or problem with the stock market, but if you take a look at this chart, this is what our current clientele base. We have 15,500 clients. This is what we educate them on because at the end of the day, numbers don't lie. If you take a look at the past 20 years, again, I always like to look at retirement accounts because you can't touch them until you're 59 and a half, decade by decade. So my apologies. This chart may not be as clear as I was hoping, but if you look at the purple line, that is a house that you may have purchased 20 years ago, giving you a rate of return of just under 200%. Not to saying that buying a house is a bad investment. Everyone's got somewhere to live or needs somewhere to live, better yet. But I do want to focus on the stock market. The S&P 500 in particular has given you 321% returns on your money in the past 20 years. But take a look at what real estate investments have given you, whether it's commercial, residential, mixed use, multifamily, private equity deals. That number is staggering at just under 2.1, I'm sorry, 2,100% returns on your money. The point I'm trying to make is, don't you think it's just as important to diversify not only a portion of your retirement dollars in the stock market, but in real estate assets? So that is what we talk about all day, every day here at the IRA Club. And as I travel all over the country, we have a whole team of 7, Samantha and Michelle. And as you well know, we met each other actually at an event, right? And what's funny is it's the same 4 reasons why I see people don't use their retirement dollars to invest in alternatives. Number one, it's lack of education. It's, you don't know what you don't know. It's not something you were brought up with, something you sat at the dinner table with your mom and dad and said, hey, I want to use a portion of my retirement dollars to go buy real estate. 2, and this is absolutely funny, is when they actually learn this concept of self-directing, this makes me laugh every single time. I'm too old to get started. The average American lives until 80. When are you ever too old to tell Uncle Sam to go kick rocks? So the point I'm trying to say is utilize these retirement dollars. And I'm going to give you some examples a little bit later about why it's so crucial to maybe possibly look at an alternative asset such as multifamily. 2, as I talked about a split second ago, identifying the investment opportunity. I hate to say this, most Americans are not savvy investors. They can't really identify and they don't know what to look into. One of the things that you guys just mentioned is performing due diligence. I love that you said that. Because that's something that we preach in one of the 4 pillars of IRA Club. But understanding who's taking all of the risk, it is you. Think about that. When you make a contribution to an employer's 401k, you take all of the risk. The only time that you get paid is if the market is up. If the market is flat or the market is down, do they still take their cut? Of course they do. But also understanding they do this through a fear factor, which I'm going to talk a little bit about later, which we refer to as artificial restrictions. And listen, Samantha, I may have mentioned this to you and Michelle. I come from a massively big family, right? I have my fair share of doctors, lawyers, financial advisors, fiduciaries. Let's just say I don't get invited to all the family dinners, okay? Because I teach their investors how to take control, right? And invest in what they want and understand best. I don't have a problem with that at all. Just understanding that everyone needs to make a living, okay? That includes my family, but it's all percentage based. Before I get into that, I want you to understand the history of retirement accounts and how they stem and where they stem from, better yet. Established September 2nd, 1974 by Congress, it was established because the Treasury Department made it very evident and clear to Congress that guess what? Less and less pensions are being offered. In fact, by 1974, 72% of companies offered some sort of pension. Today, that's less than 5%. What they didn't take into consideration, believe it or not, is every single government program from Social Security to Medicare to Medicaid, as I mentioned earlier, is completely distraught. In fact, in the last 2 years, our government has dished out $2.2 trillion. These numbers are not sustainable, so something has to give. Now, the only 3 things that you could not use your retirement accounts to invest in is collectibles, so that antique car, that antique rug, that expensive bottle of wine. You could not use your retirement dollars to invest. That's Fidelity, Vanguard, Schwab, including the IRA Club. 2, you could not invest in your own life insurance. And lastly, you could not invest your retirement dollars in an S Corp. For obvious reasons, you're already getting the tax benefits. In the IRS's eyes, that's considered double dipping. But keeping in mind that all retirement accounts across the board can be self-directed. Okay, that's the reasons why I bring that to your attention is Fidelity, Vanguard, Schwab are now adopting our terminology of self-directing. So if you just happen to be listening to this webinar today and you wanted to use a portion of your retirement dollars to invest, I'm just using the example with Samantha, let's say hypothetical situation. Well, Fidelity, Vanguard, and Schwab is going to say, no, you can't do that. But here's another pool of investments that you could be looking at. So remember, the term self-direction, just because they say it, all they're saying is you could pick whatever stocks, bonds, mutual funds, or ETFs at the end of the day that you want to choose from. But what we teach is how to get rid of this greedy SOB and keep him out of your pockets. Because understanding that 30 to 40% of what you make in your lifetime goes to this man. So the true benefits behind self-directing is not only that I mentioned take back control, but it's the flexibility to invest in what you know and understand best. I'm going to talk about fees in a split second, but for me, it's the tax-free and tax-deferred growth. So let me break this down for you and let you understand. When I talk to individuals on a day in, day out basis, what they don't realize is this. When you use your IRA or 401k or HSA dollars or any qualified retirements, you eliminate all taxes across the board. They think it's just your federal tax rate. I just so happen to live in Chicago, Illinois, one of the most corrupt states in the country. Hope nobody's listening on the other side. But if you take a look at your state rate, Medicare, Social Security, insurance, right off the bat, you're saving 14.5%. Whatever federal tax rate that you fall into, you decide that number, you break down those numbers, you could potentially be saving 30 to 40% on your ROI. So understanding when you use your retirement dollars, you accelerate your growth 25 to 50% faster, depending on how much you're investing and the time frame that you're investing. But I want to take this case study, IRA Club client. I want you to see the difference when you use your personal dollars versus when you use traditional dollars versus when you use Roth dollars. Just so you understand the difference between traditional dollars and Roth dollars. Traditional dollars, let's just say hypothetical scenario, you make a contribution, which is the max is $7,000. If you're over the age of 50, that's $8,000. That is deferred, right? So you make the contribution, you get a tax deferral. Roth, on the other hand, you don't take the deferral when you do a $7,000 contribution. It is taxed upfront, but the gains, the growth is tax-free for the rest of your life. So let me give you a case study about what I am referring to. Let's just say you have an annual rate of return of 12%. Samantha, the rest of the team that's listening, Michelle, I don't know what returns on investment are. I'm just giving the example of 12%. Let's just say it's a 10-year investment, okay? And you decide you wanted to invest $100,000. You moved it over from Fidelity, Vanguard, and Schwab over to the IRA Club to make this investment. After 10 years, this is your return if you used your personal dollars versus using your traditional dollars versus using your Roth dollars. Can you see the growth and why we're such huge advocates of the Roth? Whether it's a 401k, IRA, it doesn't matter. If you have the ability, always consider using Roth dollars to make alternative investments. The problem is, where do most individuals leave their retirement dollars? This is a scary number. 97% of Americans leave their money within banks, annuities, and the stock market. Okay. Now, bank CDs and annuities, I'm not going to go too much into great detail, maybe a little bit about annuities. Okay. Nothing's wrong and or right, but CDs for me are a little bit of an issue because it's simple interest. It's not compounding interest. I believe in compounding your returns. Okay. Annuities, on the other hand, have been very heavily targeted. Okay. I'm going to talk about stocks in a split second, but in particular, fixed income annuities. Their solution is always you don't have to worry about the market volatility, and we're going to guarantee you a fixed rate of return. The national average is about 5%. When I say it's heavily targeted, I'm talking about individuals between the ages of 50 and 60 that are about to be approaching retirement, and they are worried about the volatility of the market. So financial advisors and brokers and RIAs have been, again, heavily targeting this age bracket, this decade between 50 and 60. And what they're going to guarantee you is you don't have to worry about the volatility of the market, as I mentioned, and this is going to be your monthly payout. So think about this. You're 55 years old. You move over, I'd say 50,000 from your employer's 401k, 100,000 or $250,000. And I'm going to guarantee you $211, $421, or if it's $250,000, I'm going to guarantee you just a little over $1,000. Can anybody live off of that? The answer is no. I don't care who you are. It's very difficult if you do. I'm proud of you if you can, even if you have Social Security backing you up. But I'm just assuming that you guys can do better than 4 and 5%. Because if you guys can't do better than 4 or 5%, maybe you just hang up and leave this webinar. I'm kidding. I'm kidding. Do not leave the webinar. But let's take it into the problem with annuities, okay? When you move over funds from your 401k or IRA into annuity, the problem is you give up what we've been talking about, the control aspect of it. That's it. It's locked in. And they're very high upfront commissions when you use your retirement dollars to invest in annuities because they know they got you locked in. But what most people don't know is annuities are not FDIC insured. That's because they're not government products like an IRA or 401k. Most agents really don't know what's inside the annuity, but as I mentioned, you will no longer be in control. And if you want to pull that money out, you are going to pay a high surrender charge. I'm not saying, again, annuities are a bad thing. I leave that up to you. I just want you to be aware of what you're getting yourself into. But I am going to focus on these three because I guarantee you that almost every single person that's listening has had a retirement account with either Fidelity, Vanguard, and Schwab. In fact, these three companies control just under 70% of the $44 trillion that sits within retirement accounts. Fidelity is number one at 33%. Think about that. 33% of retirement accounts are through Fidelity. And here's what's scary. It is not a publicly traded company. It is a private company. So you never know what they're actually really charging you. But I want to focus on the pandemic a little bit and talk about numbers at this point. So, according sources Fidelity, according to CNBC, every single person by the end of the of 2021, end of quarter four, everybody was loving life. Why? We dumped trillions of dollars into the economy. You had 135,000, sorry, forgive me, 135,000 inside your 401k. Fast forward to the end of 2022, you lost 23%. IRAs lost 20%, 403bs lost 19%. Why am I saying this to you? Look at how long it took to get back to that break-even point. You see that? By the end of the third quarter, 2024, you got to that break-even point inside your employer's 401k, which means you gave up 1.8 years of your life working. This is what most people don't understand. It's what you're giving up. And your most important asset in life is time. Many of us remember the 2008 Great Recession. I think this is a powerful slide. I'm not going to go through all 12 recessions. But for those that, for example, I just use that analogy of you were 55, approaching 60 years old, you were thinking about retiring, and you lost half of the $500,000 that you had saved up for the past 20 years. That means you're going to have to work 4.3 years of your life to get to that break-even point so you could retire back with that 500,000. Because the ugly truth is these plans are not designed to benefit you. It's designed to benefit them. And they do this through artificial restrictions. And again, be careful. The term self-direction is now being adopted by Fidelity, Vanguard, and Schwab, understanding that is not true self-direction. Okay, just want to bring this home at the end of the day by showing you the actual returns on your money. And when it was a good time, right, to have a 401k plan was between 1980 and 1999. If you actually look at the history of the stock market, 1929 to 1978, your average rate of return was 4%. I want to go back one slide. Revenue Act. 401k plans were launched in 1978. You notice from 1980 to 1999, this is when the stock market blew up, is when the money started pouring in from the 401k plans, is when it gained traction. there were ever a time to listen to your mom, dad, and grandparents, this was the time period. Fast forward to 2000, to the end of 2023, look at that number, 5.68%. These numbers, again, are not sustainable. It's just to show you how one-sided our retirement system is. It is completely broken because there are 65 million IRA accounts across the country. Of those, $63 million are under a million. Sorry, 63 million accounts are under a million versus 2 million have $1 million or more. The answer is very simple. They're just in control of their retirement accounts. That's it. So with that being said, let me break it down. Fees are very important, something I really honed down on. If you do have an employer's 401k, go Google this number because most of you don't know what the average is of fees being taken out, which is 2.27%. That is the national average. Why is that? Because 83% of employers' plans live within mutual funds. Large, small, international stocks, bonds. That is their definition of diversification. That is not our definition of diversification. So 62% don't even know where to find the fees. And these are the fees that I'm referring to. Pull out your phone, take that picture. You need to ask your HR department if they could find them. What are these fees? I refer to these fees as termites because they nitpick at your retirement account. So be aware of those because if you tack up, if they are being managed, it's typically between 1 to 3%. I'm talking about all qualified retirement accounts, not just the employer 401ks. National average is always between 1 and 3%. Why am I saying this to you? Because IRA Club believes in flat fees. We do not believe in percentages. We charge every single IRA Club client $195. I don't care if you have 10,000, 100,000, a million, or 10 million. The most we could ever take from you is $195. So the question is, wait a sec, Samantha, I get this all the time. How are you guys making money at $195? It's per investment, per asset. So this house on 123 Green Street is $195. You do a multifamily deal, that's an additional $195. You invest in oil and gas, that's $195. So our business is built on volume. The average IRA Club client has about 2.5 assets under administration. Assets underneath their retirement accounts, which tacks up to be about $700. We have 15,000 plus clients. You could do the math. So let me break this down for you. Percentages versus flat fees. Let's just say hypothetical. You move over $100,000 over from Fidelity, Vanguard, and Schwab over to the IRA Club. As I mentioned, everything's always 10 years. And I'm going to keep it very conservative and say it's a 10% rate of return. IRA Club's fees, as I mentioned, is $195 versus Fidelity, Vanguard, and Schwab. As I just mentioned to you, it will be between 1 and 3%. So within that 10-year time frame, IRA Club is going to save you just under $79,000. But imagine, this is 10 years. Imagine if it was 15 years or 20 years or 25 years. Talk about the power of compounding and the difference between flat fees. This isn't my money. This isn't Samantha and the rest of the team. This is your money that they're taking from you. So you need to understand and break these numbers down because what IRA Club offers, again, most people do not understand this process. They may have heard of it, but they don't understand it. So what we want to do is walk you through this process. Remember, your money is FDIC insured. It's flat fees, as I just mentioned. Everything can be done online. I don't believe on everything being done online. You don't know the answer to something, you call. You're assigned an IRA Club representative. You think you're causing a prohibited transaction? Call, email. We're very accessible. We do the annual tax reporting, up-to-date resource center, and don't forget, we do have a trading platform. We don't have a problem with the stock market, but we do allow our clients to pick their own stocks. What does the process look like? Open, fund, invest. The only 3 things I'm going to need from you is a government-issued ID, passport, driver's license, state ID, your beneficiary's information. God forbid something happens to you. We don't want anything anything to be stuck within the courting system and whatnot. So, and lastly, your social security number. There's only 3 ways that you could fund your account: through a contribution, as I just mentioned earlier, an IRA to IRA transfer from any custodian, or an old employer plan. So an old employer 401k, 403b, 457, TSP. Keep in mind, if you're currently employed, unfortunately, you could not roll those dollars over. This is the control aspect that we've been talking about. But this is why I'm educating you that once you leave your employer, you have this option to move it over to the IRA Club to start doing alternatives. Also, if you're over the age of 59 and a half, you legally can touch it, right? But you can move over your contributions only, not your capital gains or your employer match. So after 59 and a half, you can also roll those dollars over. Also, if you have an HSA currently employed with an HSA, that could be rolled over to the IRA Club tomorrow. You don't have to wait on that. So that's a big deal. And then lastly, step number 3 is something that I can't do for you is choose your investment. So I always like to practice what I preach, team. And I'm going to offer the first year waived on the IRA Club. Okay. Learn, educate yourself, walk through it. If you have any general questions, feel free to reach out to your team and or my team. If you want to get started, pull out your phones again. Here's a QR code, but use the promo code Crown Stone to get your first year's account waived. Again, it is the first year. It's not indefinite. IRA Club does need to make money at some point. But just keep that in mind. And then if you don't know and just want to learn more, Mandy Drysdale is head of our onboarding team. We have a team of 5. We're more than happy just to have that conversation with you and see if this is something that interests you or if you just don't know what type of retirement account you have. With that being said, exactly 30 minutes, 29 minutes. I'm proud of myself. So I'm going to open it up for you guys to continue the conversation. And if there's any general questions, please feel free to let me know.
I have a question of clarity.
Yes, please do.
You did mention, just to clarify, if you're currently employed, you cannot roll over that W-2, but currently employed and having a previous employer's 401k or an IRA with a previous employer while you're employed, you can still roll over the old employer's.
So if you're
from
currently employed with a 401k, but you have an old employer 401k,
Correct.
we
Correct.
can touch that. You can roll that
Yeah.
over to us.
Got it.
The problem is where most people get hung up is they're always under the assumption that there's a penalty involved or they're triggering a taxable event because they think it's a distribution. It's not. You're moving it over from one trustee to another trustee. But in order to do so, we need that IRA account number in order not to get that 10% penalty or have that distribution. And it's also very important using the right terminology, right? Do not say, I hear people say, can you please send my money? Then they're going to consider it to be a distribution. You would like to say the right words, like, would you please roll over my dollars to, and then they're going to ask where, and you're going to give them your IRA account number. So, or an IRA to IRA transfer. It's very important to use these words, but my team will literally walk you through that process anyways. They'll actually do it for you.
Thank you for that. Thank you.
Absolutely.
Ramez, we do have one question in the chat. It's from Michelle. It says, can you do your own PML or only select from what you offer for PML opportunities?
No, so let me be clear. We'll never choose the investment for the investor. Okay. We are the administrator. So we will focus on making sure we cross the T's and dot the I's. You will present us the investment docs. We will review that with the compliance team and assuming with a verbal, and we just say, just want to confirm that you want to send, let's say $100,000, last 4 digits of your social security number, and the funds are sent out wherever they're supposed to be sent out to.
So just to bring all this information full circle and kind of like explain how it like kind of jives with what we do as far as multifamily real estate investing. We made this chart here. If you look at step number 1, you can see the first step would be to convert your 401k or your IRA from your previous employer over to a self-directed IRA. Once you do the conversion, you can then fund the account. And then after your account is funded, you're then able to explore multifamily investment opportunities or how to invest in apartment complexes. And then step number 4 is you would instruct the IRA club. You just tell them what you want to invest in, and they would transfer the funds into the property on behalf of your IRA. And this allows you to earn tax advantage returns. All of your profits will flow right back into your SD IRA account. And this is how you can grow long-term wealth and achieve financial freedom.
Yeah, so just to kind of piggyback off of the structure of that, just to give you kind of a real world scenario or example. So let's say you direct your self-directed IRA to invest $100,000 into a multifamily syndication. Over time, as a property generates returns, we specifically try to target properties with returns of an equity multiple anywhere from 1.8 to 2.2. Obviously, higher the better. So but just as a general example, if we're targeting something with a 1.8 to 2.2 equity multiple, your account could grow from that 100,000 to about 180 to $220,000, all of which would grow inside of your retirement account, either tax deferred or tax free, depending on your IRA type. And again, of course, we always recommend you check with your tax advisor to understand how this applies to your individual situation. And most importantly, again, doing your thorough due diligence on the investment before actually making the investment. And again, that's where we as a team are here to help try to guide that with our conservative underwriting. 1 point, I see the question. So 1.8 to 2.2, this would just be over the period of the hold of the property. Your typical hold time is usually 5, 7, or 10 years. It's really correlated to the loans you would get from a bank. Sometimes you can go 3 years. Sometimes if you decide, the property is doing really well and you want to sell it off early and make a quick profit, that is also possible as well. But standard would be anywhere from 5, 7 to 10 years. The longer the hold, though, you would expect higher equity multiples. So you would also, during the hold, get paid in quarterly cash flows, and then at the sale or refinance, you would get your lump sum.
A great question. Thank you so much, Lorenzo. So, what's next? Are you feeling a little inspired after hearing Ramez? Because wasn't he great? He's so great. Just such a good personality. Not that you're still on here, Ramez.
I'm still on. I'm listening to you. I'm listening.
All of a sudden, I saw the picture go back up.
No, I was patting myself on the back, but
There you go. Okay, we'll put it back on camera after the pat. Right. If you're feeling inspired, to take the next steps here and get started, obviously book a call with the IRA Club. On the next slide, we'll actually go ahead and provide those details, and we're also going to go ahead and share all that information in the chat. And then you're going to schedule a consultation, connect with our SD IRA investors, learn how to passively invest in apartments. That is why Ballora and Crownstone are here, is as previously mentioned. So feel free to connect with our teams as well. We will provide you that information on the next slide. And then, if you really, really like us, go ahead and follow us on social, and then we will go ahead and drop those handles in there for you as well. So I like this. Here's this information here. Let me go ahead and drop you the information in the chat. Or yeah.
As Ramez said, he likes phones. You got one. You can take a picture of that as well.
There you go. All right, so there's all of our information as stated in the slides. You feel free to go ahead and copy and paste that, because you probably can't do it from this slide deck. And then I really genuinely want to thank you all and hopefully encourage you. If you want to go ahead and go to the next slide, Sam. 20 years from now, you'll be more disappointed by the things that you didn't do than the ones that you did do. I thought that was a lovely quote by Mark Twain. So basically, I just want to say thank you all so much for joining us today. And we hope that this gives you some powerful perspective on your financial future. I really genuinely appreciated the information that you provided for us today, Ramez. I think that that is a lot for us to consider and think about in ways that might affect, I know personally, my kids, you know, so without further ado,
Well,
I do want to thank everybody for being on this call.
thank you for
Thank
having.
you.
Thank you, guys. Thank you.
Thank you.
Thank you.
You.
Take care. Bye, everyone.
Bye-bye.
Everyone, bye.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.